Something just broke in the global silver market, and most people have no idea it even happened. While the headlines are screaming about stock market crashes and interest rate debates, a quiet disaster is unfolding in the plumbing of the physical metal supply chain. And it all started with a signature. On February 1st, the President of the United States signed 3 executive orders imposing 25% tariffs on Canada and Mexico. The official reason? Fentanyl. The administration claims that drugs are flooding across the border and that these tariffs will force our neighbors to crack down. But let me tell you what the tariffs actually did. They just severed the jugular vein of the American silver supply. Because while politicians were talking about opioids, the market was looking at a different number, 62%. That is how much of America's silver comes from Mexico and Canada. Mexico supplies 44%, Canada supplies 18%. And as of February 1st, all of it just became 25% more expensive. Or more accurately, all of it just became unavailable. This is not a tariff story. This is a supply shock story. And if you think the chaos we have seen in silver prices over the last few weeks, the vertical moves, the crashes, the premiums blowing out, if you think that was extreme, you have not seen anything yet. Because the tariff has not even fully taken effect. And the market is already starting to fracture. Let me explain what happened in the weeks leading up to February 1st, because the market is not stupid. Traders, refiners, wholesalers, they all saw this coming. Trump had been threatening tariffs on Mexico and Canada since the campaign trail. And when he won, when it became clear he was serious, the scramble began. The data tells the story. In the 4 weeks leading up to the tariff deadline, COMEX warehouses, the vaults in New York where silver is stored for futures trading, saw an inflow of 22 million ounces. 22 million. That is not normal. In a typical month, you might see 2 or 3 million ounces move in or out. But in January, leading up to February 1st, it was a stampede. Companies were panic buying silver from Mexico and shipping it to New York before the tariff hit. They were front-running the policy. They were stockpiling. Why would they do that? Because the math is simple. If you are a refiner in Switzerland or a wholesaler in Canada, and you know that in 2 weeks, every ounce of Mexican silver you import into the United States is going to cost 25% more, what do? You buy it now. You load the trucks. You fill the planes. You move as much metal as you can across the border before the deadline. And that is exactly what happened. The COMEX vaults swelled. The supply chains went into overdrive. And for a brief moment, it looked like the market had prepared. But here's the thing. That 22 million ounces, that is not new supply. That is borrowed supply. That is metal that was supposed to flow into the market over the next 3 months, compressed into 3 weeks. It is a sugar rush. And when it wears off, the crash is going to be ugly. Let me break down why this tariff is so devastating. The United States does not mine enough silver to meet its own demand. It is not even close. According to the U.S. Geological Survey, domestic production covers maybe 30% of what we need. The rest has to be imported. And the 2 countries we rely on the most by a massive margin are Mexico and Canada. Mexico is the largest silver producer in the world, and they mine more silver than any other country on the planet. And a huge chunk of that metal flows north to the United States. Not because they are being generous, but because the U.S. market pays top dollar. American manufacturers need silver for electronics, for solar panels, for medical devices, for military hardware. And up until February 1st, that supply chain worked seamlessly. Mexican refiners would ship bars to Texas or Arizona. Canadian smelters would send shipments to Michigan or New York. No tariffs, no friction, just clean, efficient trade under the USMCA agreement. But the tariff changed everything, because while the USMCA is technically still in place, Trump used a legal loophole called the International Emergency Economic Powers Act, IEEPA. It is a law that allows the president to impose tariffs during a national emergency, and Trump declared the fentanyl crisis an emergency. So the tariffs went into effect, and the USMCA exemption did not apply, which means that as of February 1st, every single ounce of raw silver, every bar, every coin coming from Mexico or Canada into the United States got hit with a 25% tax, and that tax does not get paid by Mexico. It gets paid by the American importer. Let me say that again because this is critical. Tariffs are not paid by foreign countries. They are paid by American companies. When a U.S. wholesaler orders a 1,000-ounce bar of silver from a Mexican refiner, the refiner still gets paid the same price. But when that bar crosses the border, U.S. Customs slaps a 25% fee on it, and that fee comes out of the pocket of the American buyer. So if silver is trading at $100 per ounce, and you are importing a 1,000-ounce bar, that is $100,000. But with the tariff, you now owe customs an additional $25,000. Your cost just went from $100,000 to $125,000. And you have 2 choices. You either eat that cost and destroy your profit margin, or you pass it on to your customers. And guess what? Every single dealer in America is doing right now. They are passing it on. This is why premiums have exploded. If you go online right now and try to buy a Canadian silver maple leaf coin or a Mexican libertad, you're going to see prices that are 30, 40, even 50% above the spot price of silver. Why? Because those coins are minted in Canada and Mexico. And even though they are finished products, they still get hit by the tariff when they cross into the US. The dealers have no choice but to raise prices. But here's where it gets worse. The tariff does not just affect coins. It affects raw silver, the kind of silver that gets melted down and turned into components for industrial use. And that is where the real damage is happening. Because the industrial buyers, the companies that use silver to make solar panels or semiconductors or EV charging stations, they cannot just stop buying silver. They need it. Their factories depend on it. So they are paying the higher prices. They are absorbing the tariff, but that cost is going to show up somewhere. It is going to show up in the price of the solar panel. It is going to show up in the price of the electric car. It is going to feed into inflation. And the Federal Reserve is going to look at that inflation and say, we cannot cut interest rates. And the cycle continues. But the short-term chaos is just the beginning. The real disaster is what happens next. Because the 22 million ounces that flooded into COMEX in January, that was the emergency stash. That was the last gasp of the old supply chain. And now it is February. The tariff is in place. And the question is, where does the next shipment come from? Mexican refiners are sitting on stockpiles. But they are not shipping north. Why would they? If they ship to the US, the buyer pays the tariff. But if they ship to China or India, there is no tariff. So the metal is flowing east. This is the arbitrage vacuum. Chinese buyers pay $120 per ounce. American buyers want to pay that much, but now they have to pay an extra $25 just to get it across the border. So the refiners send the silver to China. And this creates a doom loop. Less silver comes into the United States. American buyers get desperate. They offer higher prices. But the tariff is still there. So even if they offer more, the total landed cost is still higher than what China is paying. And the metal keeps flowing away. This is how you create a permanent shortage. Not because there is no silver in the world, but because the silver is being priced out of the American market by the American government. Because on February 3rd, just 2 days after the tariffs took effect, Trump blinked. He announced a 1-month delay. He said that Canada and Mexico had agreed to crack down on fentanyl, and in exchange, he would suspend the tariffs for 30 days. But here is the thing. The damage was already done. The 22 million ounces had already been moved. The supply chains had already been disrupted. The premiums had already spiked. And now the market is sitting in limbo, waiting to see what happens on March 3rd when the delay expires. Will the tariffs come back? Will they be made permanent? Will there be another delay? Nobody knows. And that uncertainty is just as destructive as the tariff itself. Because if you are a manufacturer and you need to plan your purchases for the next 6 months, you cannot plan around a policy that changes every 2 weeks. So what do? You either overpay for inventory now to avoid the risk, or you halt production and wait. Either way, the market is paralyzed. This is the insanity of tariff policy driven by politics instead of economics. You create chaos. You destroy predictability. You force businesses to make decisions based on Twitter announcements instead of long-term planning. And the cost of that chaos gets passed on to consumers. And the people getting destroyed are not the Mexicans. It is American manufacturers. Solar companies in California who cannot get silver paste for panels. Electronics firms in Texas seeing costs spike. Defense contractors needing silver for guidance systems and sensors now facing supply delays. The tariff is a self-inflicted wound. And silver prices are going berserk. Look at what happened in late January. Silver hit $119 per ounce, driven by tariff panic. Then, when Trump announced the delay, it crashed to $78 in a single day. A 36% drop. Why? Because leveraged speculators who had bet on a supply shortage suddenly realized the shortage might not happen. So they sold. They dumped positions, they triggered margin calls, and the price collapsed. But the physical market did not crash. The premiums did not disappear. Dealers are still charging $40, $50 over spot for Canadian maples. Because they know the tariff is not gone. It is just delayed, and when it comes back, the scramble will be worse. Let me give you a specific example. SD Bullion, one of the largest online precious metals dealers in the United States, put out a warning in late January. Their COO said, quote, "The Trump administration's tariff threats have set the metals market into a frenzy. Banks and refiners are shifting stockpiles and physical silver is becoming harder to source. Investors who wait risk paying higher premiums or missing out on products altogether." End quote. That is not marketing. That is a warning from someone who moves millions of ounces every month and is watching his supply chain collapse in real time. Because here is what most people do not understand. The silver market is thin. Total annual mine production is around 850 million ounces. Global demand is over 1 billion ounces. We are running a deficit. The gap gets filled by recycling and above-ground stocks. But it is a fragile balance. And when you introduce a 25% tariff on 62% of the supply flowing into the largest consumer market, you do not nudge that balance, you shatter it. So where does this leave us? If the tariff comes back in March, we're going to see the real supply shock. The 22 million ounces in COMEX will drain, dealers will run out of inventory, premiums will spike, and prices will either explode to reflect the shortage or crash because industrial buyers stop buying and demand collapses. The market is broken. Prices are being driven by policy chaos, by tariff uncertainty, by panic. And when markets stop functioning on fundamentals and start functioning on fear, anything can happen. The smart money knows this. That is why you saw the 22 million ounce inflow in January. The people who understand the system are not waiting to see what Trump tweets next. They are acting. They are securing supply now before the window closes. This tariff is not about fentanyl. It is a wrecking ball aimed at the most critical supply chain in precious metals. And it is working. The supply chain is fracturing. Premiums are spiking. Inventories are draining. If you are holding physical silver, do not sell it. The supply shock has not fully hit yet. The 22 million ounces from January will be gone by summer. And then the real scramble begins. If you're trying to buy silver, understand that the price on the screen is not the price you will pay. The premiums are real. The tariff is real. And if you are waiting for prices to go back to normal, understand this. Normal was a world where trade was predictable, where supply chains were stable, where tariffs were the exception. That world is gone. This brings us back to the bigger picture. The reason this tariff matters is not just supply disruption. It accelerates the broader trend of deglobalization. For 30 years, the world economy was built on the assumption of free trade, the assumption that goods will flow across borders with minimal friction. That assumption is dying. We are entering an era of trade wars, of national security tariffs, of supply chain nationalism. And in that world, physical assets matter more than paper assets. Because you cannot tariff gold. You cannot sanction silver. If you own the metal, you own it. It is in your vault. It is not subject to the whims of trade policy. This is why central banks have been buying gold at record levels. This is why China is stockpiling silver. They see the writing on the wall. The era of globalization is over. And the era of hard assets is beginning. Silver went from $30 to $119 and then crashed to $78. You have to look beyond the charts. You have to look at the policies. You have to look at the tariffs. Because the price is just the symptom. The disease is a global trade system tearing itself apart. And silver, because it is so essential, because 62% of U.S. supply comes from 2 countries that are now tariff targets. Silver is the canary in the coal mine. When the silver market breaks, it is telling you that the bigger system is breaking too. The new normal is chaos. And in chaos, the only things that hold value are the things you can touch. Welcome to the tariff shock. Welcome to the supply collapse.